Welcome back, traders and investors, to Benzinga's pre-market prep, brought to you by MarketFi. I'm your co-host Joel L. Condon, sitting with Brianna Valesky. She's going to help me interview Dr. Kannoo Ravindran, and he is the author of The Mathematics of Financial Models. Doctor, how you doing today?
I'm very good, thank you. Thank you very much for having me on your show today.
Okay, well, let's just start off with your book. When did you write it, and how's it going so far?
Oh, it has been it has been quite a bit of work. It took me about 2 years to finally finish it. Partly because I've been just drawn in different directions, but basically the objective of the book was because I teach in Iceland as well as in Singapore, so. The purpose of the book was actually to kind of bring to the front the application of mathematics in finance, but more from a practical standpoint, as opposed to either being totally theoretical or having it completely, financial with very little math. So it's all about the use of math in the day-to-day finance.
And so let's just go into the math. I mean, is this something that's based on the actual financials of the companies? Are you looking into technical analysis? What is it the root of the math that you use to evaluate stocks and futures and the other
Uh,
instruments that
the
you
um, the math underlying all these things is all based on probability, actuarial, and other tools that the option pricing is built on. So it's all about applying that set of mathematics used to value options to valuing more exotic options, or to valuing what they call real options, which is basically the ability to make a choice. Like, for example, if you're a company and you decide, and let's say you're a mining company and you're deciding whether if the mine should continue or to shut down, then that becomes a decision process, and that decision process is based on a set of mathematical, probabilistic criteria. And that's basically what this book is all about. It's all about how to use math to kind of make better decisions, and how to use math to actually value options and trade options, and looking at pension products and the retirement products, and the whole nine yards, I guess.
so you have your own proprietary formula that you use to evaluate companies?
Well, believe it or not, I tout mathematics and the use of mathematics, and when I teach in universities, I talk about the use of mathematics. I've got two things that I do. One is, based on my professional side of it, because of my applied probabilistic background. So I tend to get into the use of math when I'm dealing with clients, which are mostly big banks and insurance companies and other financial organizations that kind of bring me in to kind of help them with their risk management related issues, or programs to kind of validate what they're doing internally. That's one part of it. And then the other side of it is I also run a private equity fund, which is mostly made up of my money and money from a couple of my friends. But basically in that fund I trade as well as I invest in esoteric assets and startups. Now, in that model, when I trade, that is not, you'd be surprised on the level of math that gets used sometimes. Doesn't have to be too heavy. As long as you've got good common sense and you have a power of observation, I think you can get quite far ahead with day-to-day trading. But again, you got to kind of take all these things with a grain of salt, only because the math gets you only so far. Then after that, the rest of it is there's an emotional behavior in the markets, and that sometimes can kind of put a damper on any mathematics tools that you may want to create or use in practice.
Okay, so let's talk about your private fund that you're running. Arbitraging mispriced or undervalued assets, or investing in esoteric assets. How long have you been managing this fund? And if you mind me asking, how much do you have under management?
Oh, it is again. It's really it's less than 100 million, but partly because all of it is mostly my money, and then I've got some of my friends. So it's really a private one, as opposed to raising money from other people. Because I've got no interest in doing that. One of the big reasons being, the amount of licensing that's required, and the governance and all the things that's required. Now, in terms of the types of in terms of the types of what do you call it, on the trading side, when I get into the trading side, I look for very high volatility stocks. Examples would be the Googles of the world, or or the Teslas of the world, for example, or the Amazons of the world, where these stocks have a ability to kind of move quite a bit, on news, on events, upwards or downwards. So the model that I've got, works on identifying such stocks and then kind of looking at them when they get beaten up. I'm in the type of trading strategy that I run. I don't quite focus on. I lose my interest on these stocks when they start reaching their highs. I rather focus on these stocks when they get beaten up. So the question becomes one of how do you optimally allocate your capital as these stocks are going down, because clearly you cannot capital. I mean, you wouldn't want to allocate all your capital at one shot. Let's say when Amazon goes down by $50, because it could possibly go down further. That's where this proprietariness comes in terms of using the mathematics to determine how to kind of optimally do some kind of an allocation, so that you try to kind of allocate as these things are going down. But of course the risk is, if all of a sudden this thing starts picking up again, then you have not really allocated all the funds. But that's also part of managing your risk. And then the esoteric part of it that you talked about, or you were asking about, are things that are not related to trading markets. Like, for example, I've invested in, for example, insurance policies, where many years ago, a broker friend of mine actually came to me and he said, "Hey, I've got a client, who is actually, what do you call it, purchased a keyman insurance, and they have no use for that, and they've already passed 80, 85 or something of that sort, and they wanted to actually lapse the policy, but when they went back to the insurance company, they realized that they were not getting good value for their money. So the question was whether they could actually find somebody to kind of take over and pay them up, or buy them out, so that if anything happens to them, then you become the beneficiary. So it's this kind of assets that I get into, and sometimes it's structured settlements that I get into. So it really depends on the economics. It really depends on the legality of it, and the other pieces of the puzzle that all come together.
Ravi, will you discuss your holistic risk management approach for us?
Oh, absolutely, absolutely. This is something that I primarily use, and I guess I do actually touch on this a little bit in the book, but I primarily use when I'm actually working with companies that I do risk management work for. The financial market itself has got its own behavior, own characteristics, but then when you try to combine that with other non-financial aspects of businesses, then it gets a little bit trickier. For example, if you look at it from an insurance company standpoint, when they sell variable annuities, for example, in the U.S., these are actually mutual funds with embedded guarantees that the insurance companies give out when policyholders die. That kind of combines market risk with mortality risk. So when you think about holistic risk management, you're trying to kind of look at market risk in conjunction with mortality risk, for example, and trying to find out solutions that actually can help manage the risk for the insurance companies, or finance or other corporations that may have return risk, which is not just a function of strict market risk, but it could be a market risk that is a function of something else that's kind of intertwined, if you wish, where one affects the other. So that would be an example of a holistic risk management.
Okay, so let's talk about the lack of transparencies in retail products offered by financial institutions and the role of commissions and brokers influencing investments.
Oh yeah, this has been one of my biggest pet peeve, I guess, because like as a retail consumer, I've got a lot of friends who actually sometimes are interested in buying, products, for example, from the insurance companies or other banks, and you'll be amazed at the 200-300 page document that one has to actually go through, which rarely anyone reads, but kind of a highly dependent, and they are depending highly on the brokers to actually give them better insights on terms of what the products are. So I think from that perspective, the prospectuses or the brochures that are put out, despite there's a lot of full disclosures and all those things, a lot of it are in very fine print. So because of the fine print, it's so difficult for an ordinary lay person to exactly understand what is the risk that they're taking, and what's the risk that or what is the risk of investment. So given that backdrop, I definitely think the SEC, for example, have been quite they have been quite aggressively pursuing this lack of transparency in terms of trying to make sure that that the brokers are not just advising consumers to actually switch one investment to the other simply because the commission is higher. So I think that whole part is a very it's a very gray zone right now that I still think needs to be addressed further. But the good news is, in the U.S. and in Canada, I mean, the regulations are further ahead compared to, other parts of the world, like in Asia and all those things, where I've done some of my work, where, there's a complete dislocation between transparency and regulation. So at least we are doing something right here.
So you think we need a little more regulation and a little more
Oh,
transparency?
yeah, absolutely, absolutely. Regulation from the perspective of making sure that brokers and advisors are more on the hook for making sure they provide good advice as opposed to advice driven by commissions. And that I think it's a bigger missing part. And then from the financial institution standpoint, making sure whatever products that they sell is more transparent than having things hidden in fine print, if you wish.
Okay, we got a few minutes left here in the show. I'm on the line with Dr. Kannoo or Ravi Ravindran, and he's the author of The Mathematics of Financial Matters. You said you want to touch a little bit on retirement and retirement products, for the average investor. I mean, it's something that people should always keep in mind. Could you just give us your overview on the financial products that are out there and some of the pitfalls that people should be aware of?
Oh, absolutely. I'm glad you asked. The In terms of retirement, I think I have personally, rather unfortunately, been ye- rather unfortunately, having the ability to see people who, in the late stage of their retirement cycle, are busy investing in very risky stocks, for example, hoping that it will make up for what they've lost out in many years before. So I think retirement is a very it's a very complex issue, and making sure you're self-sufficient for retirement ages is also another complex issue, because it's not really only a function of money, but it's also a function of the healthcare, your nature of health, and it also really depends on which part of the world you're living in. So one has to factor in all these things, and investment in stocks are just one vehicle that's out there. There are other things, for example, offered by insurance companies called, variable annuities, and there are other things called annuities, which some people don't like to talk about. But these are vehicles that one can use. But again, annuity, for example, it's a good investment vehicle to have. But the problem with that is now is not the right time to buy it, given how low interest rates are. So it's all about timing. If the interest rates are very high, then annuity is something that needs to be in everybody's portfolio in some shape or form. But the key thing is, I think you need a good diversified portfolio that has a combination of assets that have got risky stocks and less risky stocks, as well as variable annuities with guarantees, GICs, for example, and it's all about trying to find a balance on what works for you, and but also keeping in mind that your health requirements and the need for financial planning, so as to be able to cover your health costs, it becomes very important, because I think too many times people worry about the day-to-day living. They don't plan too much about what happens when they fall sick. So one has to kind of look at a bigger picture and sit down with somebody who's kind of a well-versed to be able to kind of advise them on that.
Okay, and just your overall thoughts on the market.
Well, as you can see, Joe, the market goes. It has been down, at times, and then quickly it bounces up again. And what while a bull market is great, and I love a bull market, I'm also very nervous that the market activity has been a little bit thin, because people are quite unsure, from a retail consumer standpoint. People are quite unsure as in, when to get in, or they're afraid that they may get in at the wrong time when the market is going downwards. So, I mean, my hope is for the market to continue, but I do expect some pullbacks. But these pullbacks, I think, are healthy corrections that I think it's needed. So, watch out for the dips, and I guess, when there are dips, don't hesitate to come in and start picking up things, and then ride it. But from a retail consumer standpoint, which is where my concerns are, for my friends, when you trade, don't try to focus on a day-to-day trading, but rather focus on, or be comfortable holding it. Be holding it for whatever time it takes, for you to really kind of benefit from whatever you've picked up at a cheap price. So that'll be more my passing judgment, I guess.
Okay, Dr. Ravi Ravindran, author of The Mathematics of Financial Models, joining us here on Benzinga's Pre-Market Prep, brought to you by MarketFi. Doctor, thanks for coming on, discussing the mathematics of the market. Have a good Thanksgiving, and we hope to speak to you again soon.
Thank you, Ravi.
Thank you very much, Joel. Thank you, Brianna, and all the best. And happy Thanksgiving to both of you and your viewers, or your audience. Thank you so much, and thanks for having me on board.